Welcome to This Explainer. Today, we're jumping right into a pretty controversial financial strategy used by the ultra-wealthy. We're going to examine how the most successful investors out there look at debt completely differently than the rest of us. They don't see it as a burden, but rather as an engine for continuous wealth creation. It's a fascinating perspective, so let's dive right in.
Think about it. For generations, we've been taught a very specific lesson about money. Our parents, our teachers, and hugely popular financial gurus like Dave Ramsey have firmly told us that debt is a trap, right? It's a sin, it's something you need to pay off and avoid at all costs. But the source material for today's explainer argues something really provocative. They claim this conventional advice is actually a rulebook written exclusively for wage earners, not for wealth builders.
This deep-seated fear we have usually stems from that ancient idea that the borrower is servant to the lender. It's a deeply ingrained belief that literally makes our stomachs turn at the mere thought of owing money. Yet the real estate investors and financial experts in our source material, who openly carry hundreds of millions of dollars in debt themselves, argue that the wealthy view debt not as a moral failing, but purely as a powerful mathematical tool.
Section 1. The Great Debt Myth and the 1971 Shift. To fully grasp this radical shift in thinking, the sources explain that we first have to look backward to understand how the fundamental rules of money completely changed over 50 years ago.
Modern financial history really hinges on two critical dates. First, 1913. That year saw the creation of both the IRS and the Federal Reserve, which fundamentally intertwined our tax and monetary systems. But the real kicker? That's 1971. That is the year the United States, and consequently the rest of the world, officially abandoned the gold standard.
See, prior to 1971, we operated on an equity-based system. Money was backed by gold. It was a tangible, physical asset. But post-1971, we moved to a fiat, debt-based system. The crucial point here is that today, all money is essentially created through debt issuance. Dollars are literally liabilities on a central bank's balance sheet. The sources argue that if you want to build wealth in today's world, you have to get close to the money supply, and that means learning how to leverage debt.
Section 2. Consumer versus owner mindsets. According to the experts in our explainer sources, thriving in this post-1971 system requires completely abandoning what they call the middle-class mindset and fully adopting an owner mindset.
If you've got a consumer mindset, you view work as a strictly transactional way to pay for living expenses. And when consumers use debt, they generally use it to buy things they can't afford right now, like a bigger house, a luxury car, or a fancy vacation. These are liabilities. The owner mindset, on the other hand, works strictly to buy cash-flowing assets. When they use debt, it's not because they lack the money. It's because borrowing someone else's money is simply cheaper capital than using their own.
One of the speakers shares a pretty incredible story about his parents to illustrate this real-world impact. Back in the 1960s, his mother bought a house for $11,000, and around the same time, his father bought a life insurance policy with a $10,000 death benefit. To his dad, they were roughly equal investments at the time. Well, fast forward to today, his mother's house is worth over $800,000 because it's a hard asset that rose with inflation. Meanwhile, his father's life insurance policy, tied to fiat paper currency, is still worth exactly $10,000. It's been completely stripped of its purchasing power by that very same inflation.
The big takeaway from the sources is crystal clear. The current financial system heavily punishes consumers and greatly incentivizes owners. If you simply work for wages and spend your money, you're getting taxed the absolute hardest. But if you own assets, hold them as collateral, and borrow against them, you unlock capital that the IRS currently does not tax.
Section 3. The Infinite Money Strategy. Now we get to the actual core mechanism these wealthy investors use to grow their capital infinitely, all without triggering massive tax bills.
They call this process harvesting appreciation. Normally, if an asset goes up in value and you want the cash, you just sell it, right? But when you sell, the IRS steps in to take their pound of flesh through capital gains taxes. Harvesting appreciation avoids this entirely. By keeping the asset, you let it continue compounding in value, but you issue new credit or debt against it to extract the equity as tax-free liquidity.
Okay, let's break down the exact steps of how this loop operates. Step 1, you buy a cash-flowing asset. Step 2, you let time and inflation drive up that asset's value. Step 3, you execute a cash-out refinance, paying off the old debt and putting the new, tax-free excess cash directly in your pocket. Step 4, you reinvest that cash into acquiring even more assets. And then the cycle just continues.
We see this perfectly demonstrated in a real-world example from the source material. One of the speakers bought a 267-unit apartment complex in Flagstaff back in 2005. Over nearly 2 decades, he hasn't sold it once. Instead, he's refinanced it 3 separate times. Through this method, he has extracted $14 million in tax-free cash to reinvest, all while his tenants are the ones effectively paying off the monthly mortgage. It literally operates just like a tax-free ATM.
Section 4. Navigating the risks. Now, I know what you might be thinking right about now. This sounds like an absolute financial cheat code. But the speakers in our source material are quick to clarify that playing with millions of dollars in debt carries massive, inherent risks that you absolutely must respect.
Getting this wrong has a brutal reality. One of the speakers painfully recounts a devastating lesson from the 2008 financial crash. He had built a mixed-use building listed for $12 million, and he actually turned down an $11 million offer holding out for more. Well, when the market crashed, he became a forced seller, lost it to the bank, and it was sold for just $4 million. He lost all his equity. Today, that exact same building is worth $20 million. The lesson here? Time heals real estate, but only if you can hold on to it.
To explain their relationship with risk, the experts use these fantastic analogies. They compare debt to fire or to swimming in the ocean. Yes, if you go out into the ocean recklessly, you can drown. If you play with fire, you'll burn your house down. But if you learn to swim and wear a life jacket, or if you keep the fire safely contained inside the fireplace, it becomes an incredibly powerful and useful tool.
Section 5. Rules for good debt. So, how exactly do they keep the fire in the fireplace? These investors rely on incredibly strict internal guidelines to ensure they survive any market downturn and never end up as forced sellers.
A crucial rule of thumb mentioned by one of the experts is their overall leverage limit. Despite owning over 10,000 apartment units, they purposefully maintain their debt levels at roughly 50%. They never max out their borrowing power, which leaves a massive buffer of equity to protect them when market valuations inevitably drop.
Beyond those leverage limits, this strategy relies on 4 golden rules of good debt. First, the debt must be non-recourse, meaning if everything goes wrong, the bank can only take the property itself, not your personal savings or your home. Second, someone else, like a tenant, must be paying the monthly debt service. Third, the asset has to cash flow positive today, the very day you buy it, because nobody can predict future interest rates. And finally, you structure the duration of the loan so you never have a gun to your head forcing you to sell at the bottom of a market cycle.
Interestingly enough, there are exceptions to this infinite money strategy. For ultra-rare, generational trophy assets, the strategy changes entirely. One speaker details a 100-year-old resort he owns in Sedona. Because it's a legacy asset meant to be passed down to his children, he chose to place absolute zero debt on it. In this specific case, eliminating 100% of the lender risk was just way more valuable to him than harvesting the equity.
Ultimately, this explainer reveals that debt is entirely neutral. It's simply a financial instrument. The wealthy treat it as a tool to harvest tax-free wealth, while everyday consumers use it to dig themselves into a hole. So the real question this source material leaves us with is this. Looking at your own life, is your current mindset setting you up to be punished by the forces of inflation, or are you positioning yourself to harness it?